Welcome, everyone. My name is Monique Madden, and I'm the head of financial life strategies at ETF Capital Management and U Potential. Those of you who've been listening to my recordings this year will know that we are recording shorter, more easily digestible webinars this season, and as always, I welcome your feedback and ideas for future topics. Before we get started, though, just one housekeeping item. As with all recorded matter, the information that I present to you today is current as of its day of recording. Many of you will recall the groundbreaking work by Robert Kiyosaki and Sharon Lechter entitled Rich Dad, Poor Dad. It was written in 1997, and Rich Dad, Poor Dad, along with the classic The Wealthy Barber by David Chiltern, by the way, I have a signed copy of that one, these books did a magnificent job of demystifying personal finance topics and empowering Canadians to become more active participants in their own financial planning. You might recall one of the principal ideas presented in Rich Dad, Poor Dad is the idea of passive income that you can earn in your sleep. For most, this comes in the form of regular income from investments, interest or dividends. Now, interest and dividends are different. Interest is an obligation of a company or a government that's deductible to the company, but then becomes taxable to you in the same way as your income from employment either is or was taxed. Dividends, on the other hand, are paid out of after-tax profits of a company. Since these dividends were taxed to the corporation before they were paid to you, the shareholders get a tax break on this income in the form of a dividend gross-up and tax credit mechanism. This tax break is intended to ensure that that same income isn't taxed twice, once in the hands of the corporation and then once in the hands of the shareholder. Rich Dad, Poor Dad explained the idea of passive income supremely well. Living off of your own efforts for the rest of your life would mean that you could never retire. Saving throughout your working years and then using accumulated funds as a mechanism to generate reliable income is the ideal. But dividends are especially beneficial not only for their tax treatment, but also for their regularity. Most companies pay dividends quarterly, as opposed to fixed income instruments that pay only semi-annually or annually. This makes a big difference when it comes to generating reliable cash flow during retirement to allow you to support a sustainable lifestyle. Now, without getting too technical, the taxation of dividend income is designed to estimate the income as it was before the corporation distributed it to you as that dividend, and then credit back the amount that's already been taxed in the hands of the corporation. To you and me, this means that we report 138% of the dividend on our tax return. That's referred to as the grossed up amount, with an accompanying 15% tax credit on the grossed up amount. On the surface, it kind of sounds unfair. Why would we be taxed 138% of the amount paid to us? But this table shows you that when compared with other forms of regular periodic income, the gross up and tax credit method provides us with more after-tax money to support our lifestyle. For example, let's look at how $25,000 in income is taxed. Let's assume there's no other taxable income in the year. So that 25,000, whether it's in employment income, interest income, or RIF withdrawals, will leave you with $22,300 to spend. In contrast, 25,000 in dividends leaves you 24,700 to spend. That's an incredible difference, especially if you multiply it over, several fold. It's actually an increase of 11%. As with any source of information, though, you have to look at how this affects you personally. My only criticism of dividends is that for the mass affluent sector, which I characterize as those who have to be kind of careful with taxation, but aren't yet pushed into the highest tax brackets and who are in retirement. You see, an abundance of dividends will erode your entitlement to old age security. As you may know, OAS begins to be eroded when your taxable income reaches its threshold, which for the 2022 taxation year is just a little bit less than $81,800. And then it's completely eliminated if your individual taxable income exceeds $133,000. Unfortunately, the amount that's included in the clawback calculation is the grossed up amount of your dividends. In other words, before the credit is applied. According to my calculations, Canadians who collect full Canada Pension Plan but has no other sources of regular income, no employer pensions, rental income, or RIF withdrawals, you really can only collect a little less than $48,400 in actual dividend income each year before a portion of OAS is clawed back. So some ways to enjoy that predictable periodic income produced by dividends include controlling the amount of dividends produced in your non-registered account. As you probably know, dividends produced in TFSAs, RSPs, or RIFs, they don't affect your annual taxation. So if you like dividends as an investment strategy and you want to enjoy regular income that you don't have to worry about constantly, perhaps consider placing these investments in tax-sheltered accounts. Now, don't get me wrong, this is actually in direct contrast to the traditional notion that dividend-producing investments should be placed in non-registered accounts precisely because the after-tax income is more generous. But if you're in that demographic that would be affected by the OAS clawback threshold, your net income in retirement is, let's say, between $81,700 and $133,000, then you can grow your wealth in your RSP and then withdraw it as income rather than dividends for the purpose of preserving your old age security. However, if you're not projected to have income exceeding $81,700, or you're projected to have income far exceeding $133,000, then keeping your dividends in your non-registered account will provide you with a much higher after-tax amount to spend. In other words, if you're not going to get OAS anyway, or you're nowhere near the clawback threshold, put the dividends in your non-registered account. Another way to control the OAS clawback is to defer your OAS to age 70 and use the intervening years to alter your investment strategy in anticipation of OAS. If you're planning on retiring at 65, this leaves you 5 years to adjust your portfolio so that you are positioned to minimize your tax burden and maintain as much of the OAS as you can. Even those with substantial portfolios, keep this in mind that the OAS is only fully clawed back at individual exceeding $133,000. So even if you dip your toe beyond the threshold, all is not lost unless you have income exceeding $133,000 per year. Oh, and on the subject of deferring OAS, don't forget that OAS is permanently enhanced for every year that you defer it. The rate increase is about 0.6% per month or 7.2% per year, up to a maximum enhancement of 36% if it's initiated at age 70. And finally, and most importantly, please keep reading and considering financial strategies that can support you living your best life. But before you implement those strategies, give some consideration of the repercussions, whether it's taxation, access to funds, or the repercussions on your old age security. And of course, if you need help, reach out so that we can discuss whether what you're reading would really be worthwhile for you. As always, thank you for your time and attention today. To share questions, comments, and ideas for future webinars, please contact me by email at monique@upotential.com. And if you want to see how UPotential's planning services can help you reach your potential, visit www.upotential.com/service to arrange a consultation.